Yo guys, welcome back to another video here at TraderJourney on YouTube. Again, another very quick video for you guys. This is just covering off some of the foundations just to prepare anyone who's getting started in options trading. I'm going to be covering out the money, the scenarios you would expect to buy out the money contracts with a strike price of out the money. So I'll be explaining that whole concept on this video. So if you haven't checked out the other videos, I've made videos on in the money and at the money. So if you want to understand those concepts, be sure to check those two previous videos which I've uploaded. But let's get straight into this. So this is covering off the out of the money scenario. Now it's sometimes referred to as OTM. You'll notice in some of my chats I will refer to it as OTM, especially in Instagram. If I'm speaking out the money, I'll just refer to it as OTM. It's just easier to type out. You can buy out the money put contracts as well as out the money call contracts. A lot of you should be aware of that already from my previous videos. It is important to understand when to purchase an out the money contract and when to avoid them. You wouldn't, for instance, use an out of the money contract when scalping. It just won't give you a good return for the time you're in the trade. It's just not a good return on investment for those type of contracts. I'll give you an example which will hopefully help to explain what out the money actually means. Out the money call contracts, for instance, is simply when the underlying stock value is above the strike price of the contract. So if a Apple was at $100, an out the money contract would be a strike price of $120, for instance. Now an out the money put contract is simply when the underlying stock value is below the strike price of the contract. This is simply the reverse of the in the money concept. So if you've seen the in the money video, you'll understand this is just literally the opposite of in the money. And so yeah, you can apply the concept to put contracts or call contracts. Here's an actual example. So Apple stock is say £100. You want to play an out the money call swing. Now a swing is when you hold a trade for more than a day. So say 2 days, 3 days, up to a week, maybe a month. So that's what a swing trade is. So you're essentially in the trade for a long period of time. You would therefore need to buy a contract with a strike price of £101 or higher, because that is effectively out of the money. At the money would be £100, in the money would be £90. So out the money is above that. For this particular call swing, it would be above the stock price, the underlying stock price of Apple. So when to buy out the money contracts? As a general rule, you should only buy out the money contracts when placing a swing trade. A swing trade is a trade you hold overnight, days or weeks. You would also buy out the money contracts when purchasing leaps. Now leaps are contracts expiring in say 6 months to 2 years, so a very lengthy time you would be holding these contracts. Say you were very bullish on Apple, they have some rumors of an Apple car coming out in the next year to 2 years, and you think that the stock is going to go up by a lot. You could buy an out the money contract expiring in say next year, for instance, based on that rumor. And if you were confident enough and you did your technical analysis, you could place a trade like that, for instance. Now you would generally be in these trades for a much lengthier time compared to a day trade or scalp, which is why when scalping you go in the money, because you want to get higher deltas to effectively get a higher return for the 2-3 minutes you're in the trade. And a day trade, as you've seen from my previous videos, you would be buying at the money contracts. The reason why a out the money contract is more beneficial when placing a trade for a swing is that out of the money contracts cost a lot less. So if you look at the options chain on whatever platform you're using, look at the cost of the contracts compared to in the money and out the money. You'll notice out the money contracts are a lot cheaper. So when swinging, your stop loss won't actually exit the trade for you if the stock price hits the stop loss during the pre-market or aftermarket hours. So that's a particular risk you need to be aware of, because if the stock price just crashes overnight, your stop loss won't hit until market opens. So you effectively will lose a lot more money. So the risk in swinging is much higher. So you would generally buy cheaper out the money contracts to mitigate the risk. So as I said, out the money contracts are a lot cheaper than in the money or at the money. so you are mitigating a lot more risk by buying out the money contracts. As a beginner, I would say you should avoid swing trading to start with, because obviously the risk is there that you could lose a lot more than say your 10% risk strategy, because the prices can fluctuate a lot more during pre-market and after hours when you're not able to actually trade. So your stop loss is ineffective, and it won't save you from losing more money. So that's something to be aware of for any beginner traders out there. So that pretty much covers what I wanted to say on this video. I hope that all makes sense. I have covered 2 other videos on other scenarios such as in the money and at the money. If you want to get some more understanding for it, be sure to check out those videos. If you've got any sort of questions, feel free to let me know in the comment section below, or hit me up on my Instagram, as I'm more than happy to help anyone, or any questions you might have, just feel free to DM me and I'll be sure to give you guys some help. So thanks very much for watching. I will catch you all on the next one. Take care. Goodbye.